Welcome back to the CFO's office. In our last session, we celebrated. We talked about making profits, watching our stocks grow, and collecting dividends. We discussed the happy dilemma of whether to reinvest that money or take it out and enjoy it. You did the hard work. You took the risk. You earned the reward. You feel successful. But before you order that expensive bottle of champagne to celebrate, there is someone waiting outside your office door. He has been waiting patiently the entire time you were investing. He is your silent partner. He takes no risk. He contributes no capital. He does no work. But he demands a significant percentage of your profits by law. His name is the Taxman. Today, we are going to open the most boring, complex yet financially critical book in the CFO's library, the tax code. If you ignore this topic, you are not a CFO. You are an amateur. You can be the best stock picker in the world, generate 20% returns every year, and yet end up with far less wealth than someone with lower returns who manages their taxes efficiently. In the corporate world, companies spend millions hiring experts to legally minimize their tax bill. You, Inc., must do the same. Today is your complete guide to taxes, capital gains, and dividends. First, we need to establish the golden rule of investment taxation. The CFO does not care about gross return. The CFO only cares about net after-tax return. It is not what you make. It is what you keep. Let's start with the biggest chunk. Capital gains tax. A capital gain is simply the profit you make when you sell an asset for more than you paid for it. You bought a stock for $100. You sold it for $150. You have a $50 capital gain. The government wants a piece of that $50. But here is the crucial concept that separates the rich from the average investor. Not all gains are taxed equally. The government uses the tax code to incentivize certain behaviors. They want you to be a long-term investor, not a short-term speculator. Therefore, they created two different tax buckets: short-term capital gains and long-term capital gains. If you buy an asset and sell it within 1 year, 365 days, or less, any profit you make is considered a short-term capital gain. The government treats this money just like your salary. It is taxed at your ordinary income tax rate. Depending on your income bracket and where you live, this could be as high as 30%, 40%, or even 50%. Think about that. You take all the risk, and if you win quickly, the government might take half. Now consider the alternative. If you hold that same asset for just 1 day longer than a year, 366 days or more, your profit becomes a long-term capital gain. The tax rates for long-term gains are significantly lower. For many people, they are 15% or 20%. For some lower-income earners, they might even be 0%. This is a massive difference. By simply having the patience to hold for a year and a day, you can potentially cut your tax bill in half. This is why the CFO of You, Inc. always looks at the calendar before pressing the sell button. Selling on day 360 versus day 370 can mean a difference of thousands of dollars in your pocket. Patience is literally profitable. Now let's move to the second type of investment income, dividend tax. You own a great company. They share their profits with you every quarter. It feels like free money landing in your account, but of course it is taxed. And just like capital gains, there are two buckets. Bucket 1 is ordinary dividends. Most dividends start here. These are taxed just like your paycheck, at your highest marginal income tax rate. If you are a high earner, this hurts. Bucket 2 is qualified dividends. These are the gold standard. If a dividend meets certain criteria, usually involving holding the stock for a minimum period of time, it is taxed at the much lower preferential long-term capital gains rates, that 15% or 20% range we talked about. Again, the pattern is clear. The tax code rewards holding. It punishes churning. The government is practically begging you to be a patient, long-term owner of businesses. So, now that we know the rules of the game, how does the CFO play defense? How do we legally minimize the silent partner's share? We use 3 primary strategies. Strategy number 1, the power of unrealized gains. Remember, you only pay tax when you sell. If you buy Amazon stock at $100 and it goes to $1,000, you have a massive $900 gain on paper. How much tax do you owe this year? 0. As long as you do not sell, your money compounds tax-free. This is an incredible advantage. You are essentially getting an interest-free loan from the government on the taxes you would have owed. The smartest CFOs let their winners run for decades, deferring taxes as long as possible. Strategy number 2. Asset location, tax-advantaged accounts. Governments want you to save for retirement. To encourage this, they create special accounts like IRAs or 401(k)s in the US, or similar pension schemes globally that offer tax breaks. Some accounts let you deduct contributions now and pay tax later. Others let you pay tax now and pay zero tax later. The CFO's job is to ensure that these accounts are filled first. Why pay taxes on your investments today if the government has given you a legal way to avoid it? Put your least tax-efficient assets, like bonds that pay interest or stocks that pay high ordinary dividends, inside these sheltered accounts. Keep your tax-efficient long-term growth stocks in your regular taxable accounts. This is called asset location. Strategy number 3. Tax loss harvesting. This is turning lemons into lemonade. In a previous session, we talked about firing non-performing divisions taking a loss. When you sell a stock for a loss, it is painful. But the CFO sees a silver lining. That realized loss is a tax asset. You can use that loss to offset your gains. If you made a $10,000 profit on stock A, but you took a $4,000 loss on stock B, the government only taxes you on the net $6,000 profit. Smart CFOs proactively look for losses at the end of the year to cancel out their gains and lower their tax bill. It doesn't make the loss feel good, but it makes it less expensive. Let's summarize the tax strategy for you, Inc. Do not trade in the short term unless you love paying high taxes. Hold good companies for over a year to unlock lower tax rates on both gains and dividends. Max out your tax-sheltered retirement accounts first. And use your losses strategically to offset your wins. The tax code is thousands of pages long. It is designed to be confusing. But the principles are simple. The government rewards patience and retirement planning. Align your strategy with those incentives, and you will keep more of what you earn. We have now covered how to raise capital, manage risk, allocate assets, take profits, and handle taxes. Your You, Inc. is running like a professional operation. But there is one final layer of defense we must build. It is the foundation upon which everything else rests. If this foundation cracks, it doesn't matter how good your tax strategy is. You will be forced to liquidate your company at the worst possible time. In the next and final episode of this module, we will discuss the most vital rule of personal finance survival. We will talk about the principle of separating emergency funds from investment capital. We will ensure that when life happens, your portfolio doesn't have to pay the price. Go review your portfolio for long-term versus short-term holdings. I'll see you in the next video.